Today, we're doing a complete breakdown of AASB 107. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying AASB, prepping for a Big Four interview, or working in finance, this is everything you need to know. Before AASB 107, companies could mask their true cash position. Imagine a company reporting profits, but hiding a negative cash flow of $10 million. AASB 107 changed the game by mandating transparent cash flow statements. Now, you'll see how this standard ensures you know exactly where the cash is coming from and going. AASB 107 was introduced to solve the opaque cash flow reporting issues. Before its implementation, many investors were in the dark about a company's liquidity. Imagine a firm showing profits while hemorrhaging cash. With this standard, companies must clearly disclose operating, investing, and financing cash flows, which significantly enhances transparency and comparability across different entities. Under AASB 107, every entity that follows AASB must prepare a cash flow statement. This requirement kicked in from 1991, transforming financial reporting. The most significant mandate is the classification of cash flows into operating, investing, and financing categories. This clarity allows stakeholders to identify how cash is generated and used, crucial for assessing financial health and sustainability. The cash flow statement model is a powerful tool, breaking down cash flows into operating, investing, and financing activities. For example, operating activities cover cash received from customers. Investing activities might show cash outflows for new equipment. Financing captures cash from loans or equity. Understanding this model is vital for interviews, as it reveals a company's cash generation prowess and financial strategy. Understanding the scope of AASB 107 is crucial. Many candidates mistakenly include cash flows from taxes unrelated to operating activities. These are classic traps interviewers use to test your depth of knowledge. Knowing what the standard explicitly covers and excludes can be the difference between a high-stakes mistake and a standout performance. The scope of AASB 107 includes cash flows from operating, investing, and financing activities. For instance, when a company receives cash from customers or pays off its suppliers, these are operating activities. Similarly, buying machinery falls under investing activities, while receiving a loan or issuing shares are financing activities. These classifications help stakeholders understand the business's cash movement. AASB 107 explicitly excludes specific items, which often become interview traps. For example, while operating cash flows include taxes, those not directly related aren't covered. Dividends paid, a transaction with owners, are another exclusion. Also, non-cash transactions like exchanging shares for assets aren't part of cash flow statements. These exclusions ensure clarity and prevent misclassification. Cash, under AASB 107, refers to physical currency and demand deposits. It's the funds you can instantly access for transactions, such as the money in your wallet or your bank account. For instance, a retail store's cash register balance and its bank account balance fall into this category. Understanding this helps in accurate cash flow reporting, as it affects liquidity analysis and short-term financial planning. Cash equivalents are investments that can be quickly converted to cash without significant value loss. They include treasury bills or money market funds, which typically mature in 3 months or less. For example, a company might hold excess cash in a money market fund, ensuring liquidity while earning a small return. These investments play a crucial role in cash management, helping companies maintain liquidity and meet short-term obligations. Edge cases often trip up candidates. Imagine a company paying taxes on a capital gain. It's excluded from operating activities in AASB 107. Receiving dividends typically falls outside operating cash flows. When companies engage in non-cash asset swaps, these aren't part of cash flow statements either. Government grants, depending on their nature, require careful classification. Understanding these nuances is key to mastering the standard scope. Imagine a company struggling to track its cash movements accurately. The cash flow statement model under AASB 107 solves this by categorizing cash flows into operating, investing, and financing activities. This clarity allows businesses to effectively manage liquidity, funding, and investment strategies, ensuring sustainable growth and financial health. This model's purpose is to transform raw financial data into a structured format, highlighting cash movement trends. We'll explore this with Meridian Corporation, which has a $10 million SaaS contract. They received $8 million for a software license and $2 million for implementation services. Understanding each step in this model allows us to clearly track how cash flows through different business activities. Consider Meridian Corporation's $10 million SaaS contract with Acme Incorporated. Cash received from Acme for software and services falls under operating activities. Many candidates misclassify contract-related cash flows, which can distort financial analysis. It's crucial to separate operating inflows, like customer receipts, from other cash types. Operating cash flows are the lifeblood of the business, setting the stage for assessing the company's core financial health. Building on Meridian Corporation's scenario, we now focus on cash flows from investing activities. Any capital outlay toward the software infrastructure would fall here, distinct from operating cash flows. Companies often err by misclassifying maintenance as investing, skewing analysis. AASB 107 requires precise categorization to reflect true investment in long-term assets. This step ensures that capital investments align with business growth strategies. Continuing with Meridian Corporation, financing activities encompass cash inflows from share issuance or debt to fund operations. Misclassifying interest payments as financing is a frequent mistake, leading to inaccuracies. AASB 107 requires clear segregation of financing cash flows, ensuring transparency in capital structure analysis. This clarity helps stakeholders understand how the company funds its growth, with $8 million software and $2 million service milestones in mind. With Meridian Corporation, after categorizing cash flows from operations, investments, and financing, we sum these to find the net cash change. Omitting categories can lead to significant errors. AASB 107 requires a comprehensive view to ensure financial accuracy. This step highlights whether the business generates or consumes cash over the period, crucial for assessing liquidity and operational efficiency. Finally, Meridian Corporation reconciles the net cash change with its opening and closing balances. This reconciliation step is critical to confirm accuracy. Skipping it can result in discrepancies, misrepresenting the company's liquidity. AASB 107 mandates this reconciliation to ensure financial statements portray a true cash position, aiding stakeholders in making informed decisions. With $10 million in play, accurate reconciliation underpins strategic financial planning. The measurement method you choose directly impacts your balance sheet. A wrong choice can overstate assets by millions. Precise disclosures ensure stakeholders understand financial health, highlighting cash flows and liquidity. With AASB 107, Australian entities provide clarity, detailing cash flow activities, changes in liabilities, and more. Let's explore the mechanics of measurement and disclosure in depth. AASB 107 mandates recognizing cash flows when transactions occur, crucial for accurate period reporting. Imagine a $100,000 sale recorded in December. Recognizing it in January skews financials. Initial measurement uses the nominal amount at transaction date, enhancing comparability. Transactions under the materiality threshold, like minor office supplies, can be excluded, focusing on impactful data. Under AASB 107, ongoing measurement ensures cash flows reflect current realities. Reevaluate at each reporting date. For instance, a $200,000 expected inflow might shrink to $180,000 due to client issues. Cash equivalents stay at original cost unless impaired. Only adjust foreign cash flows for major exchange swings, maintaining stability. AASB 107 ensures clear cash flow presentation by segmenting into operating, investing, and financing activities. Interest received, for instance, appears under operating activities, enhancing clarity. Notes detail accounting policies and cash equivalents, fostering transparency. Non-cash transactions, like asset swaps, are separately disclosed, ensuring stakeholders don't misinterpret cash status. This structured approach aids in financial analysis and decision-making. AASB 107 mandates disclosing net profit to net cash reconciliations, crucial for understanding operating cash flow conversions. Interest and tax cash flows must be detailed, offering transparency. Entities disclose changes in financing liabilities, covering cash, like $1 million loan repayments, and non-cash shifts. Highlighting non-cash deals, such as asset swaps, ensures stakeholders grasp the full financial picture, aiding in accurate analysis. Consider a CFO managing $500,000 in operating cash, ensuring precise reporting. Quarterly remeasurement of liabilities, like a $200,000 loan adjusted for interest rate changes, prevents misstated financials. An equipment purchase for $300,000 gets accurately classified under investing activities. Separately disclosing a $100,000 non-cash asset swap maintains transparency, ensuring stakeholders see the full financial landscape and aiding in strategic decisions. Meridian Corporation, a global manufacturing company, signs a 5-year operating lease for its Singapore warehouse. Watch how every accounting event plays out. Meridian Corporation records the right-of-use asset and lease liability at the lease's inception, reflecting the present value of lease payments. AASB 107 requires this recognition to ensure that both the asset and liability are accurately reflected on the balance sheet. This initial entry sets the stage for tracking lease payments and obligations. The initial lease payment reduces the lease liability by $20,000, reflecting Meridian's obligation towards the lessor. AASB 107 mandates recognizing this outflow, as it decreases cash while fulfilling part of the lease liability. Meridian's cash flow statement will show this payment, impacting both the balance sheet and cash flow statements. Interest on the outstanding lease liability must be accrued as per AASB 107, which ensures that the financial costs linked to the lease are recognized over time. This entry increases both the interest expense and the lease liability by $3,000, thereby reflecting the cost of using the leased asset over the period. AASB 107 requires the depreciation of the right-of-use asset to be spread evenly over its useful life. For Meridian, this means a monthly depreciation expense of $10,000. This allocation reflects the gradual consumption of the asset's economic benefits, impacting both the income statement and balance sheet. Year-end adjustments are crucial under AASB 107. Meridian discovers a gain from lease reconciliations of $5,000, reducing its lease liability. This adjustment ensures that the lease liabilities accurately reflect the obligations remaining at the year-end. Such entries are vital for presenting a true financial position in the statements. Derecognition is the final step, removing the lease liability and right-of-use asset from the books. Under AASB 107, this process involves eliminating these accounts, reflecting the fulfillment of all lease obligations. Meridian's balance sheet is now relieved of this liability, marking the end of the 5-year lease period. Every Big Four and investment bank interview on AASB 107 follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. AASB 107 sets the standards for cash flow statements, ensuring clarity in financial reporting. It requires companies to report cash flows from operating, investing, and financing activities. This enhances comparability across firms. The main mistake is confusing cash flows with accrual accounting. Remember, focus on actual cash movements, not accrued items. AASB 107 exists to provide a clear methodology for reporting cash flows, ensuring transparency and comparability. It helps stakeholders understand a company's liquidity and financial flexibility. A common error is misclassifying cash flows between categories. Always categorize based on the nature of transactions. Memorize operating, investing, and financing as the primary categories. Dividends received are typically classified as operating cash flows, reflecting the cash received from investments. However, they can also be investing cash flows if they relate to returns on investments. The confusion arises when deciding between operating and investing categories. A solid rule: classified based on the business model and nature of the investment. Interest paid can be classified as either operating or financing cash flows. The choice depends on whether the interest supports current operations or is part of financing activities. A common error is not aligning with the company's financial strategy. Takeaway: be consistent with the classification approach based on the firm's reporting practices. Indian Accounting Standard and AASB 107 differ mainly in the classification of cash flows and the disclosure of non-cash transactions. Indian Accounting Standard requires more detailed disclosures for financing activities. The trap is assuming they are identical. Remember, while both standards aim for transparency, Indian Accounting Standard often demands more extensive disclosures. International Financial Reporting Standards and AASB 107 are largely aligned, with minor differences in presentation and disclosures. International Financial Reporting Standards allows more flexibility in classifying interest and dividends. The misstep is overlooking these nuances. Key point: while aligned, always check for regional variations in guidance for precise compliance. Start by adjusting net income for non-cash items like depreciation and changes in working capital. For example, if net income is $100,000, depreciation is $10,000, and receivables decrease by $5,000, operating cash flow is $115,000. The pitfall is ignoring changes in working capital. Key point: include all adjustments for accuracy. Non-cash transactions, like asset exchanges, are not included in the cash flow statement, but must be disclosed in the notes. For instance, exchanging equipment valued at $20,000 is a disclosure item. The common mistake is failing to reconcile with net income. Always ensure proper disclosure for transparency. Certain transactions like non-cash financing and investing activities are outside AASB 107's scope for cash flow statements, but require note disclosures. The trap is overlooking these in cash flow analysis. Remember, cash flow statements focus solely on cash, but related disclosures are crucial for financial transparency. AASB 107 requires disclosure of non-cash transactions, components of cash and cash equivalents, and a reconciliation of cash flows with net income. A typical pitfall is failing to provide detailed reconciliations. Memorize: completeness and clarity in disclosures are essential for accurate financial reporting and stakeholder trust. Grasping AASB 107 starts with its aim: enhancing cash flow comprehension for better liquidity insight. Covering all entities preparing financials under AASB, it defines cash as readily available funds, including demand deposits. Distinguishing cash equivalents, it refers to short-term convertible investments. Operating activities cover revenue-centric cash flows, while investing involves asset deals. Financing addresses equity and borrowing transactions, completing the standard scope. AASB 107's model offers two methods: direct for detailed cash transactions and indirect for a broader view. It segments cash flows into operating, investing, and financing, aiding in analysis. Foreign operations use current exchange rates, while interest and dividends fit activity-based categories. Taxes typically fall under operating activities. Non-cash items require separate disclosure since they're absent from the cash flow statement. Interview prep for AASB 107 starts with avoiding classification errors in cash flow activities. Know the minimal differences with IAS 7 for global alignment. Key disclosures include cash flow detail and non-cash transactions like leases. Segment cash flows should fit standard categories. Understand direct versus indirect method nuances. Lastly, applying exchange rates accurately to foreign cash flows ensures precision. Master these essentials to stand out. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to Candy Mentor for more accounting and finance videos.